On December 2nd, 2001, the seventh largest company in America filed for bankruptcy. Months earlier, its stock traded near $90. Now it was worth 26 cents. 20,000 people lost their jobs, and many their life savings. The company was Enron. It did not run out of oil or lose to a rival. On paper, it looked worth a fortune. So how much of it was ever really there? To understand the fall, you first have to understand what Enron actually was. Let's start in 1985, in Houston, Texas. Two rather boring pipeline companies merged into one and took the name Enron. For its first years, that is all it was. A company that owned thousands of miles of steel pipe and moved natural gas through them. Dull, steady, useful. Then the rules changed. Through the 1980s, the American government deregulated natural gas, which simply means it stopped fixing the price and let the market set it instead. Suddenly, gas had a price that moved every day like a stock. And Enron's chairman, a soft-spoken former economist named Kenneth Lay, saw the opportunity in that. Why merely own the pipelines? When you could trade the gas that flowed through Enron began to reinvent itself, from a company that owned things into a company that made deals. In 1990, Lay hired a sharp former consultant named Jeffrey Skilling, and Skilling arrived with a vision. He wanted Enron to become a kind of bank, but for energy, a middleman that bought and sold gas contracts rather than pumping gas itself. But he had one condition for taking the job. He insisted on an accounting method called mark-to-market. Put it this way, say you sign a 20-year contract to deliver gas. Under normal accounting, you record the money as it actually arrives, year by year. Under mark-to-market, you estimate the total profit of the entire 20-year deal and you book all of it today, as if you had already earned it. Nothing has actually been paid. The profit is a forecast, but on the books it now counts as real earnings, this quarter. In 1992, regulators let Enron do precisely this. That one permission is the seed of everything that follows. Now think about what mark-to-market does to a company over time. Once you have booked 20 years of profit today, that profit is spent, gone. Next quarter, to show that you are still growing, you need a fresh deal, an even bigger one, to book on top of it. And the quarter after that, bigger still. Wall Street adored the growth, so the stock kept climbing, which only raised the pressure to keep the streak alive. Enron had built itself a treadmill it could never step off. And to be fair, a forecast is not fraud. Businesses forecast all the time. The danger was the pressure wrapped around it. Because who produced the estimates behind all those future profits? Enron did. If a deal began to look less profitable than promised, admitting it would mean reporting a loss. So the incentive, every single quarter, was to imagine the rosiest future possible. The company was, more and more, grading its own homework. And the grade always had to be an A. With that accounting engine humming, Enron went on a spree. It decided it could trade almost anything. Electricity, coal, steel, internet bandwidth, even the weather, selling contracts that paid out if it rained or snowed. In 2000, it launched Enron Online, a website to trade energy at a scale nobody had seen. And because trading let Enron count the full value of each contract it handled as revenue, that revenue simply exploded. In 1996, Enron reported sales of about $13 billion. By 2000, it reported more than $100 billion. On paper, it had become the seventh biggest company in the country, larger than IBM, larger than Sony. Fortune magazine crowned it the most innovative company in America, 6 years running. Now, Enron did own real things, real pipelines and real power plants. But increasingly, its reported glory was a story about trading, and about trading profits that were, in large part, still just forecasts. For a while, this looked like genius. Then came California. In 2000 and 2001, California had deregulated its own electricity market, and Enron's traders learned to play it. Internal strategies with cartoonish nicknames, Death Star, Get Shorty, Ricochet, did things like route power out of the state and back in again to dodge price caps, or collect fees for relieving congestion the traders had helped create. As they gamed the system, California suffered rolling blackouts and electricity bills soared. Federal regulators would later document these tactics in detail. And this is the part that gets lost when Enron is told only as an accounting story. Enron was not merely cooking its own books. It had learned to bend a real market, one that millions of ordinary people relied on just to keep the lights on. The same instinct. To extract value from the gap between what is real and what can be engineered ran through everything the company touched. But underneath the soaring stock, a problem was quietly swelling. All this trading and building demanded cash, enormous amounts of it, and Enron was borrowing heavily to fund it. The trouble is, large debt makes a stock look risky, and a falling stock would be fatal to a company that ran on confidence. Enron needed the debt to simply disappear. That job fell to its chief financial officer, a young financial engineer named Andrew Fastow, and his tool was something called a special purpose entity. This sounds technical, and it is, but the trick itself is simple. A A special purpose entity is a separate little company you set up for a single specific deal. Used honestly, they are legal and completely ordinary. But Fastow used them the way a magician uses misdirection. Enron would shift its debt and its worst performing assets into these entities. The debt did not vanish. It was still owed. It simply no longer appeared on Enron's own balance sheet. Out of sight, out of mind. These entities carried odd, boyish names. Chewco, a set called LJM and the Raptors. And here the conflict turned grotesque. Fastow, Enron's own chief financial officer, secretly ran some of the very partnerships sitting on the other side of Enron's deals, and he personally pocketed millions from them. Years later, an internal investigation by Enron's own board, known as the Powers Report, spelled out what these structures had concealed. Pulling just one of them, Chewco, back onto the books raised Enron's reported debt by more than $700 million in a single year, and cut its reported profits at the same time. In plain terms, the company had been far more indebted and far less profitable than it had ever told its investors. And through all of this, one group was specifically supposed to catch it, the accountants whose entire professional job was to check the books. So why on earth didn't they? Enron's auditor was Arthur Andersen, one of the 5 most respected accounting firms on the planet. An auditor's whole purpose is to be the independent referee, to examine a company's books and tell the public whether they can be trusted. But there was a quiet rot in the arrangement. Andersen did not only audit Enron, it also earned enormous fees from Enron for consulting work, tens of millions of dollars every year. The referee, in other words, was being paid, and paid richly, by the very team it was supposed to be judging. When your single biggest client wants the numbers to look a certain way and hands you a fortune, the pressure to go along becomes almost irresistible. So, the accountants did not simply fail to notice the fraud. The system had been built so that the people best placed to catch it had every reason in the world not to look too hard. The watchdog had been quietly turned into part of the machine. By the summer of 2000, Enron looked completely untouchable. In August, its stock hit its all-time high, just under $91 a share. Skilling was about to step up to chief executive. The smartest people in finance held the stock, praised the company, and repeated its story back to one another. And that, it turns out, is exactly the moment a story like this is at its most dangerous, when almost nobody is bothering to ask the one simple question. Not, how much money is Enron making, but rather where, precisely, is all that money coming from? Because a small handful of people had finally started to ask. And the answers, when you looked closely, did not add up. The first real crack came from a magazine. In early 2001, a Fortune reporter named Bethany McLean published a short article with a quietly dangerous title, "Is Enron Overpriced?" She had done the one thing almost no one else had bothered to do. She read the filings closely and then admitted, in print, that she could not clearly explain how Enron actually made its money. That question, once spoken aloud, refused to go away, then. In August 2001, Jeffrey Skilling abruptly resigned as chief executive after only 6 months in the top job, citing personal reasons. For a man who had built his entire identity on Enron, walking away at the very peak looked less like a career move and more like someone stepping off a train he already knew was about to crash. Behind the scenes, the hidden structures had begun to unwind. October 16, 2001, is where the calendar starts moving fast. That day, Enron announced a shock, a $618 million loss for a single quarter, and it quietly erased more than $1 billion of its own net worth, all tied to Fastow's partnerships. Days later, the Securities and Exchange Commission opened a formal investigation. The stock, already sliding, dropped toward $20. In early November, Enron was forced into the most damning act of all. It restated years of past earnings, admitting that hundreds of millions of dollars in profit it had previously reported had, quite simply, never been real. The hidden debt was coming home, all at once. And a company that had run for years on nothing but the confidence of investors and lenders was about to discover exactly what happens when that confidence vanishes inside a single month. Here is the cruel mechanism of the ending. A trading company is only ever as good as its credit, its ability to borrow and to be trusted on the far side of a deal. As the losses surfaced, the credit rating agencies downgraded Enron's debt down toward junk, and that was the death blow. Trading partners stopped dealing with it overnight. Loans came due that Enron could no longer repay. A rival called Dynegy briefly agreed to buy Enron in a rescue, then read its books more closely and quietly walked away. In the space of a few weeks, the 7th largest company in America simply ran out of cash. The stock that had touched $91 only the year before was now trading for pennies. The great machine that had run for so long on confidence had finally been asked to prove itself, and underneath, there was almost nothing there. On December 2nd, 2001, Enron filed for bankruptcy. With more than $63 billion in assets, it was the largest corporate bankruptcy in American history to that point. Within days, thousands of employees, around 4,000 at the Houston headquarters alone, were laid off. But the deepest wound of all was the retirement savings. Enron had encouraged its own workers to hold their 401k retirement accounts in Enron stock, and roughly 60% of that money was tied up in it. As the stock collapsed, many employees were locked out, unable to sell during a scheduled freeze on their accounts, and they watched their savings evaporate in real time on the screen. All told, Enron workers lost well over $1 billion in retirement money. The people who had trusted the company most completely with their futures turned out, in the end, to be the ones with the very least protection. Then at last came the reckoning. Andrew Fastow, the chief financial officer behind the partnerships, pleaded guilty and cooperated with prosecutors. He ultimately served about 6 years. Jeffrey Skilling was convicted and sentenced to 24 years, later cut to 14. He was released in 2019. Kenneth Lay was convicted as well, but he died of a heart attack before he could be sentenced, and by law his conviction was then erased. And Arthur Andersen, the century-old auditor? It was convicted in 2002 of obstructing justice for shredding Enron documents, and it effectively ceased to exist. 85,000 people around the world lost their jobs, but here is the twist that almost no one ever mentions. In 2005, the Supreme Court unanimously overturned that very conviction. The firm had been destroyed over a case the government, in the end, actually lost. One of the greatest names in accounting was gone regardless, and it was never coming back. But out of all that wreckage came the one thing that outlived everyone involved. In July 2002, Congress passed the Sarbanes-Oxley Act, and it forced real, lasting change. Auditors could no longer sell heavy consulting work to the same companies they were auditing, closing the exact conflict that had captured Andersen. Public companies now had to test and prove their internal financial controls. And most striking of all, chief executives and chief financial officers had to personally sign their own financial statements, under genuine threat of prison, certifying that the numbers were true. If you have ever wondered why a modern public company treats its own accounting with something close to paranoia, a very large part of that answer traces straight back to this one collapse. Enron did not merely end a company. In the process, it quietly rewrote the rules for all of them. So, was Enron really almost entirely on paper? Not quite. And the truth is more useful than the myth. Enron did own real pipelines and real power plants. But its reported greatness rested on two tricks that fed each other. It pulled tomorrow's profits forward and counted them as today's. And it pushed today's debts sideways into companies that existed mainly to hide them. Neither trick required a single evil genius. It required a system in which everyone's incentives, the executives, the traders, the auditors, the analysts, all quietly pointed the same direction, toward the comfortable story that the numbers were fine. That is the takeaway, and it is an uncomfortable one. No single person ever set out to bring the company down. Fraud on this scale is almost never one lone liar. It is usually a machine, carefully built so that telling the plain truth becomes the one thing that nobody in the building is actually paid to do. One last detail. The specialist brought in to clean up Enron's wreckage was a restructuring expert named John Ray. 2 full decades later, in 2022, he was handed the wreckage of the crypto exchange FTX. His blunt verdict on FTX? In his entire career, he said. He had never seen a more complete failure of corporate controls. The mechanisms change. The lesson, it seems, just takes a little longer. And to be clear, this is history, not financial advice. So, which surprised you more, pulling profit forward or pushing debt sideways? Tell me in the comments below.